Hi, I'm here with Chris Jordan, President and CEO of Superior Gold, and Andrew Bigg, Vice President of Long-Term Planning and Development, to comment and answer questions on the recent January Plutonic operational update. Chris, January looks to have been a good month for the operation. What brought about this change?
Scott, yeah, thank you. The strategic changes made to the business in Q4, following a detailed analysis of business performance and the operations in Q3, really hinges around a singular and primary focus on the underground mine. Now, as you know, the open pit operation was suspended in October 2022. The operating model has subsequently been aligned to this, and operations commenced executing on an accelerated improvement program on the underground mine. Now, in addition to that, we made some structural changes in the operational team, simplifying the focus of the underground mine manager and creating dedicated technical services manager and maintenance manager roles. This approach includes a relentless focus on the basics of improving the leading underground performance indicators of development rates and production drilling rates. This is having a positive impact on inventories, production ore mined, grade, and ultimately gold production. Now, to allude a little bit further on that, production increased to 5,942 ounces of gold in January. This is a 17% increase on the December 2022 results and a 29% increase on the average monthly production in Q4. The gold production from the underground in January increased to 5,856 ounces, representing a 47% increase relative to the Q4 2022 average, and a 56% increase to the Q3 2022 numbers. The company continues to target improved stope grades of 3 grams per tonne in the second half of 2023, as development rates continue to allow access to additional higher grade stopes.
And Chris, can you comment on the leading indicators?
Yeah. I have to say we're very excited on our performance improvement that we're really starting to see the benefits of all the hard work that we put in Q4 after we devised the strategy going forward. So once again, our focus is purely on the basics here. Now, the first goal of this turnaround is to access more higher grade stopes. A 3% increase in development meters to 675 meters per month in January was achieved relative to Q4 in 2022 and 26% relative to Q3. Now, moving on to production drilling. In January, production drilling reduced 12% relative to Q4 in 2022. However, it's an 84% increase relative to Q3 in 2022. Now, January was slightly less than Q4 because we had some issues on the rig. But that's subsequently been rectified. The overall trend remains positive post-January, and we are well on track towards an average of approximately 20,000 meters per month from Q2 onwards. Moving on further to total mine ore mined, and this is probably one of the biggest changes that has happened. We started to seeing that happening in December and seeing that through into January as well. Now, as a result of more stopes being available due to improved development rates, a 25% increase in total ore mined to 87,959 tonnes per month was achieved in January relative to Q4 2022 average, and it's a 48% increase relative to the Q3 average monthly production. In the last 2 months, ore hauled from underground clipped 1 million tonnes per annum annualized, and that's ahead of target. Moving on to broken stock. The broken stock inventory increased by 50% in the underground to 27,700 tonnes at the end of January relative to the end of Q4 in 2022, and over 3 times the broken stock available at the end of Q3 in 2022. Now, remembering that the volume of ore moved from the underground has increased significantly. Commensurate to that, we've also seen an increase in stope grade of 6% to 2.54 grams per tonne in January relative to the Q4 average. And then ultimately moving to underground costs, because that's ultimately what we're targeting here as well. The improved productivity enabled a 17% decrease in underground unit cost per tonne to circa $100 per tonne relative to the Q4 2022 average. And that is a 20% decrease relative to Q3 2022. Now, commensurate to this decrease, underground unit cost, the cash cost per ounce, has reduced by circa 20% relative to Q4 average and more than 12% relative to FY 2022. Now, once again, I want to stress this is based on unaudited results, but the results and the directional movement of these results are very encouraging.
That's great. And Andrew, what can the company do to accelerate the inclusion of these higher grade areas into the mine plan?
Yeah, thanks, Scott. I mean, the key point here is getting our development rate up and accelerating our development performance. That gives us options in the plan, and that enables us to lift our stope grade. You can see in January we achieved 2.54, an increase on December, and we're targeting 3. So more development gives us more options. In addition, we've done a lot of work in the technical space, particularly in Q4. And what we've done is we've actually developed concept area plans for the full calendar year 23 budget plan. Now, what that does is that enables us more development headings and more grade control drilling platforms, which then provides more options, leading to high stope grade. So we've really de-risked the plan a lot from a technical perspective, and it's a big step forward from where we've been in the past.
Right. And Chris, why did development fall so far behind in 2022, and what measures have you taken to get ahead this year?
The COVID-19 pandemic impacted Western Australia later relative to the rest of the world, as WA was isolated longer than other states. We faced an industry-wide shortage of skilled labour in Q2 and Q3, to the point where some mobile equipment was left idling. We also suffered from some poorer performing equipment, which hindered productivity. Since we've replaced an aging jumbo with a brand new and larger development jumbo, augmented by a new loader and a truck, as well as reconfiguring the utilisation strategy of the jumbos. This has contributed to achieving quarterly development rate of 657 metres per month in Q4, compared to only 525 metres per month on average in Q1 to Q3. This further increasing to 690 metres in January, and we are well on track towards 750 metres per month from the second half of the year.
Right, and can you provide some insight into the mill refurbishment last year, as well as the move to batch processing this year? And is this yielding benefits?
Yes, this maintenance was way overdue. Now, typically this maintenance is done every 7 to 10 years on a milling circuit. This has, however, never been done since the start of the mills in the 1990s. The main concern was related to higher than upper limit vibration on the mills. The refurbishment was a complete success, and we've demonstrated the mill can now run at 1.8 million tonnes per annum. The move to batch processing has saved on labour and input cost, while more efficiently utilising the processing capacity whilst it's in operation. Now, there still remains between 800,000 and 900,000 tonnes of milling capacity available as we continue to improve our development and bring more mining fronts into production in the future. In the meantime, it allows potential toll milling with others in the Plutonic region.
Great, thanks for that. Andrew, the mine life at the operation has increased significantly with the last mineral reserve and mineral resource upgrade. What's the plan to continue growing the mine life at Plutonic and leverage the higher grade potential targets that are there?
Yeah, Scott, after the resource and reserve was released in mid last year, we embarked on what we call a life of business planning process. And we took all of the reserves, our view on what resources that may convert into reserves in the future. And then we assessed a number of scenarios across that resource and reserve, and we came up with some optimised plans from our perspective. We were able to prioritise all of the underground zones and we've brought them forward and prioritised them based on value. And we've also been able to establish a prioritised pipeline of opportunities for growth and projects to study and look at. And these are some options that haven't been previously considered. In addition, we've got a great resource, and we still have a lot of underexplored potential within the Plutonic leases. So we're able to prioritise exploration targets to continue and look at, further into the year. The other piece that's really important, Scott, I'll mention, is that based on the fact that we were able to optimise the plan and then prioritise the mining areas based on value, that has set the bookends for the 2023 plan. So we're really confident that we've got a long-term plan that's backed up by a short-term plan, and we've done the right thinking so that we continue to grow and deliver value for the business.
Great. Chris, does the plan for improving development and stabilising gold production this year include contingencies? And what are some of the key issues that might affect this plan?
Yes, Scott. So firstly, we have the right team, equipment in place, and the momentum to continue to improve development and drilling. Some of the challenges that we and all other mines face is competition for skilled labour and, of course, unplanned equipment failure. We have dedicated strategies and work programs to manage both of these risks.
Andrew, for the target ranges, such as the development target of 750 metres per month, is that a linear target, or can we expect that to be variable on a month-to-month basis?
Yeah, look, it's a good question, Scott, and it's a question that we do get. Look, 750 metres a month is definitely our goal, and we're building up to that, and we're quite close to that at the moment, as you can see in the numbers. The reality is, though, as we work through the plan throughout the year, we based where we dedicate our resources on priority of the plan and obviously priority of the equipment. So that will go up and down throughout the year on individual month basis. But we're targeting, particularly in half two or from Q2 onwards, an average of 750 a month. And we're quite confident that we will meet and definitely in time exceed that target. But we know that that's a sustainable rate to set us up for a good production platform, and which will unlock high grade options from a stope perspective.
Right, that makes sense. Chris, are you able to provide some comment on the guided 65 to 74,000 ounces per annum and at an all-in sustaining cost of 1,600 to 1,800 in 2023? And what might that look like from a cash flow perspective?
Yeah, as a general rule, break-even is between 5,300 and 5,500 ounces. So anything above that is free cash. We should also see margins start to improve in the second half as we begin to access higher grade ore in the mine and gold remains above $1,800 per ounce. Although the recent run in the gold price has been somewhat offset in Australian dollar terms.
Right. And can you comment on why the cash burn was abnormally high in Q4 and any of these costs ongoing, and can we expect to see a similar cash burn going forward?
Yeah, that's a good question. There were several things included in that cash burn, including restructuring costs related to the open pit stoppage. There were costs associated with adding another lift to the existing tailings dam, which lets us push off the capital expenditure for the construction of a new facility until at least 2024. There were also ramp-up costs associated with increasing the underground development, which are front-end loaded, and it creates a lag before we see the benefit of increased tonnage. And we now in January and showing in our production results that benefit is slowly but surely trickling through in our ultimate results.
Right. So it sounds like a lot of one-offs were contained within that Q4.
That's correct, yes.
And the company finished 2022 with approximately 8.1 million in the bank, including drawing down on a gold loan. Does the operation currently support an improvement to the balance sheet for 2023?
Yes. Now, the successful ramp-up of production and the way that our leading indicator performances are improving, in combination with our cost reduction initiatives, has improved the cash generation ability of the business. We expect this to further improve in the second half. As I said, our stope grade is expected to increase then. And we have the margins at current gold prices to repay the gold loan, meet capital expenditure requirements, and build cash as the year progresses.
Great. Andrew, does the company have the right people in place to execute on this new strategy in 2023?
Yeah, absolutely, Scott. And, you know, in addition to the productivity and cost improvement initiatives that we're running, and Chris touched on it earlier in the conversation, we have done some very deliberate and discrete structural changes. So, for example, the underground mining manager was looking after the mine execution, was looking after the mobile maintenance, and it was looking after the technical services. We've simplified the focus of the underground mining manager to focus on delivery of the plan. We've uplifted the capability in the technical services space with a dedicated technical services manager, and we've done the same in the maintenance area as well. You know, their focus, their simplified focus, their raising of the capability of the conversation of what needs to happen on site as well is really starting to benefit, and you can see that coming through in some of the results we've had in January.
Mm-hmm.
That's great. Chris, in addition to the move to batch processing, what else is the company doing to lower its operating costs and ensure the company remains positive or cash flow positive throughout the cycle?
So our approach was very simply to focus on our compressible cost, those things that we can have an influence on. So to reduce our operational costs further, we've restructured the operations to align with the operational strategy. We reduced non-critical capital expenditures. We optimized the warehouse stock holding and completed a process to increase on-contract spend compared to off-contract and tech spend. The net result so far is that the total operating expenditures have reduced by circa $2.5 million per month compared to the average per month in 2022. Now, this is inclusive of the savings due to the suspension of the open pit operations.
Thank you for that. Andrew, the company's previously talked about a new tailings facility in 2023. I know Chris briefly touched on it, but this potentially is a significant capital expenditure. Does the company have options around deferring this to a later date?
Yeah, we do actually, Scott. And Chris mentioned earlier in the Q4 costs, we did perform a tailings dam lift on an existing facility. You know, that does give us additional capacity, and that in combined with the batch milling strategy really we don't need a new tailings facility until mid-2024. We will be performing some study work in 2023 around tailings strategy and optimizing future capital spend and tailings facilities. But we will not be incurring significant expenditure for tailings in 2023. The majority of that will come in 2024 when we're looking to build a new facility.
Right, thanks for that. There's an upcoming hearing on the 2016 right of first refusal litigation with Van Gogh. Are you able to provide any comment on that?
Yeah, look, I think what I will comment on is, you know, we do have an existing relationship with Van Gogh through our K2 project joint venture committee, and we have been meeting with them on that. In respect to the 2016 appeal before the court at the moment, our current operating strategy and project options do not rely on it. However, if it is in our favour, definitely there could be accretive options to our plan, and we will assess that obviously depending on where the appeal lands. But you know, we're not relying on it for our success in the future, but it would be an attractive option if we had that in our portfolio.
Yeah, I'd like to add to that. I think the process that we followed through this year to build the life of business plan will certainly put us in a position to, depending on the outcome of this appeal, to include those considerations in our life of business plan. So once again, we'll have an overarching view of where we're going with the business.
All right, thanks, Andrew. Thanks, Chris. And Chris, finally, providing the year goes smoothly and according to plan, what's next for Superior Gold's growth plan?
Yeah, so I think first and foremost, and we're very clear about it, our short-term focus is purely on the underground mine, and we wanted to ensure that we continue to deliver sustainable and improving ounces each month while keeping our costs in check. Now, next would be the potential expansion of the underground rekindling exploration strategy. Given the comment that Andrew made earlier on, vast areas of unexplored tenements still on our property, and of course, then investment in studies, which may include tenements towards the east of the property, like Plutonic East.
Great, thank you very much. That was really useful from where I sit. So thank you, Chris, and thank you, Andrew, for your time.
Yeah, thanks for your time, Scott. Thanks, Chris.